Imagine waking up on a random Tuesday morning. You go through your usual routine, the smell of coffee brewing, the quiet hum of the house before the world wakes up. You open your investment app, just a quick check like you always do, and then you see it. Something strange. Yesterday, while you were sitting at your desk, dealing with emails, sitting through meetings, and trading your life force for a paycheck, your portfolio generated $412 in gains. You do some quick mental math. After taxes, your take-home pay for that same grueling 8-hour day of work was exactly $320. For the first time in your life, your money made more yesterday than you did. This isn't a fluke. It has been happening more and more frequently lately. You realize that theoretically, you could have stayed in bed yesterday, gone for a hike, or spent the entire day with your family, and you would have been financially better off than if you had actually showed up to work. This moment has a name. It is called the crossover point. And here is the terrifying reality. Most people will work for 40 years and never even know this moment exists. They are trapped in a cycle of trading their time for money until they're 65, hoping that Social Security and whatever tiny amount they've managed to scrape together will be enough to keep them from drowning. But there is another path, a mathematical inevitability that, once you understand it, changes how you see every single dollar you earn and every minute you spend. It turns money from a tool for consumption into a tool for sovereignty. The crossover point isn't a mindset hack or some vague get-rich-quick philosophy. It is a specific, calculable point that you will reach if you understand the two fundamental lines of your life. The first line is your expenses. This is the cost of existence, your rent, your mortgage, your utilities, groceries, and that monthly car payment. For the average American household, this number is a heavy, flat line that stays relatively constant, though it often creeps upward due to inflation. This line represents your dependence on the system. The second line is your investment income. This is the money your money makes while you sleep. Through dividends, interest, and capital appreciation, this line starts out flat at zero. In the beginning, it's frustrating. You invest $1,000 and it makes $5. It feels like it's not moving the needle. But here is the secret that the wealthy understand. Compound interest is an exponential function. It doesn't rise in a straight diagonal line. It rises in a curve that gets steeper and steeper the longer you stay in the game. For years, the lines stay far apart. You work, you save, and it feels like you're getting nowhere. But then the curve starts to take over. The crossover point is the exact second that green curve screams past your expense line. It is the moment work becomes optional. Not because you are a billionaire, but because your assets have taken over the job of providing for your life. You have officially transitioned from a laborer to an owner.
Let's put some real cold numbers on this so it's no longer abstract. To find your crossover point, you have to understand the 4% safe withdrawal rate. This is the gold standard of financial independence math, derived from the Trinity study. It states that you can safely withdraw 4% of your portfolio's value every year, adjusted for inflation, and your money will likely last forever. Let's say your monthly expenses are $4,000. That is $48,000 a year. To generate that $48,000 passively, you need a portfolio of $1.2 million. Now, I know what you're thinking. Adrian, $1.2 million? I'm making $60K a year. I will never see that kind of money. But let's actually run the numbers for a 30-year-old. If you invest just $500 a month at an 8% return, which is actually below the historical average of the S&P 500, something incredible happens. For the first 10 years, it feels incredibly slow. You have about $91,000, which pays you only $300 a month. It barely covers your phone bill and some groceries. But you keep going. By year 20, you have $275,000. By year 30, the curve goes vertical.
You hit your $1.2 million at age 65. That is the slow path. It works, but it takes a lifetime. What if I told you that 1.2 million isn't a fixed destination? What if you could move the finish line closer to you right now? The crossover point is a function of two variables, your portfolio size and your expenses. Most people only focus on the portfolio side, trying to earn more and more. But reducing your expenses moves the crossover point toward you from both directions. It is the ultimate financial shortcut. Let's look at the math. In our first scenario, you needed $1.2 million to cover $4,000 in monthly costs. But what if you optimized your life? What if you house-hacked, eliminated your high-interest debt, and got your expenses down to $2,000 a month? Suddenly, your freedom number isn't 1.2 million anymore, it is $600,000. By cutting your expenses in half, you didn't just save money, you deleted 17 years of mandatory labor from your life. You literally bought back nearly 2 decades of your time. And because your expenses are lower, you have more surplus cash to invest. If you invest $1,000 a month instead of $500, you hit that $600,000 target in just 18 years. You could be financially sovereign in your late 40s instead of your mid-60s. This is the leverage most people ignore because they are too busy trying to keep up with the Joneses. Adrian wants you to focus on the gap. The wider the gap between what you earn and what you spend, the faster that green line explodes. Most people think of financial independence as a binary switch. You are either a slave to your paycheck or you are free. But that isn't how it feels in the real world. It is a gradient. It is a slow buildup of power. When your investments generate $500 a month, your car payment and insurance are covered forever. You don't work for that car anymore. Your money does. When they hit $1,000, your groceries and utilities are free. At $2,000, your housing is covered. Each milestone on the way to the crossover point gives you more bargaining power. You can say no to the boss you don't respect. You can take that career risk you've been dreaming about. You can work 3 days a week instead of 5. This is why the threshold of $100,000 is so psychologically important. Charlie Munger once said that the first 100K is a bitch, but you have to do it. Before that number, you are the one pushing the money. It feels like hard work. But after 100K, the money starts pushing you. You can viscerally feel compound interest working. It becomes a living, breathing worker that never gets tired, never complains, and never asks for a raise. Once you realize that every $1,000 you invest is a permanent worker added to your army, you will never see a mindless purchase the same way again. You aren't just spending money, you're selling your future soldiers. Now, let's address the elephant in the room. What about the crashes? What about the 20% drops that dominate the news cycle? If you understand the crossover point, market crashes aren't disasters, they're accelerants. When the market drops, you are buying more workers for a lower price. It is a massive clearance sale on your freedom. While everyone else is panicking, the person focused on the crossover point is shopping. And then there is the concept of coast fire. This is the point where you have invested enough that even if you never add another cent for the rest of your life, compound interest alone will carry your portfolio to your freedom number by retirement age. If you are 30 years old and have $150,000 invested, you have already won. You could theoretically never save another penny, switch to a low-stress job you love, and still retire a millionaire. The 4% rule was built to withstand this volatility. It was tested against the Great Depression, the stagflation of the 70s, and the dot-com bubble. It held up. Your crossover number will rise with inflation, but historically, the companies you own through your index funds will raise their prices too. They are the ultimate inflation hedge. The only real risk isn't the market crashing. The real risk is never starting at all and remaining 100% dependent on a labor market that can replace you in a heartbeat.
Here is your homework. Adrian wants you to stop guessing and start calculating today. Step 1. Calculate your real monthly expenses. Go through your bank statements and find the truth. Step 2. Multiply that number by 25. That is your crossover number. Step 3. Subtract your current investment balance. That is your gap. Every $1,000 you invest today is roughly $40 of passive income for the rest of your life. Every $100 you cut from your monthly bills is $30,000 less you need to reach freedom. One random Tuesday, years from now, you are going to wake up, check your accounts, and realize that the lines have finally crossed. The silence of that realization will be the loudest sound you've ever heard. It is the sound of the cage door opening. You won't feel like a different person, but you will own your time. And that is the only true wealth. I've spent way too much time thinking about this, so you don't have to. If this shifted your perspective even a little bit, make sure to smash that like button and subscribe for more content that challenges how you think about money. I'm Adrian, and I'll see you in the next one.